Ever pondered how some investors seem to have a crystal ball predicting stock market trends with uncanny accuracy? Welcome to the world of the stock market, a complex and fascinating realm that commands global economies. Some view it as a chaotic, unpredictable beast, while others see it as a meticulously organized system governed by data and trends. Now, to the uninitiated, the stock market might look like an enigma, a massive, unpredictable whirlwind of numbers and charts. But, rest assured, it's not as chaotic as it seems. Imagine it as a giant puzzle waiting to be solved, where every piece represents a company, an industry, or an economic trend. The trick lies in putting together these pieces to form a coherent picture. And that's what successful investors do. They don't just gamble on a hunch, they make informed predictions based on careful analysis and understanding. So remember, the stock market isn't a game of luck. It's a game of skill, knowledge, and strategy. Before we dive into the deep end, let's wade into the shallow waters of basic stock market concepts. Imagine a bustling city, where each building represents a company. The size of these buildings isn't defined by their physical dimensions, but by their market capitalization. It's the total market value of a company's outstanding shares of stock, a key indicator of a company's health and stability. The bigger the market cap, the more stable the company is perceived to be. Now, each of these buildings is divided into countless individual rooms. These rooms, my friends, are what we call shares. When you buy a share, you're essentially buying a tiny piece of that company's building. You become a part owner, and with ownership comes perks. One of these perks is dividends, a portion of the company's profits that's distributed to shareholders. Think of it as a thank you gift for your investment. But wait, you're probably wondering, how do I make money from owning shares? Well, it's a game of buy low, sell high. You purchase shares when the price is low, and if the company performs well, the share price increases. You can then sell your shares at this higher price for a profit. But remember, the stock market is like a roller coaster, always going up and down. There's no guarantee of making a profit, and there's always a risk of losing money. That's why it's crucial to understand the stock market's language. It's like learning to read the matrix. Once you understand it, you can see the patterns, the trends, and potentially predict the market's next move. It's about making educated guesses, not just throwing darts in the dark. Stock market investing isn't a get-rich-quick scheme. It requires patience, research, and sometimes a bit of guts. But once you get the hang of it, it can be a thrilling ride. Now that we've got the basics down, we can plunge into the more intricate aspects of stock market analysis. Now imagine you're a detective and the stock market is your crime scene. How do you start solving the mystery? Well, just like a detective, you need to look for patterns, follow the clues, and use some cool tools. This is where trend analysis comes into the picture. It's like your magnifying glass, helping you examine those tiny, crucial details that can make a big difference. Trend analysis is not about predicting the future. No, it's about understanding the past. It's about diving into historical data and finding patterns that might help us make sense of what's happening right now and what could possibly happen next. Now, you might be wondering, where do we find this historical data? Well, it's everywhere. Stock prices, trading volumes, economic indicators, all these are pieces of the puzzle. And the great thing is, most of this information is readily available on financial websites and platforms. But here's the thing. Just having the data is not enough. You need to know how to read it. For this, we have market indicators. These are tools that help us interpret the data. They're like our decoder rings, translating complex information into something we can understand and use. There are many types of market indicators, but they all serve one purpose: to help us identify trends. Some indicators, like moving averages, help us spot a trend's direction. Others, like the relative strength index, can tell us if a trend is gaining or losing steam, and then we have patterns. These are recurring price movements that can signal potential market moves. For instance, the head and shoulders pattern can indicate a possible market downturn, while the double bottom pattern might signal a market rebound. But remember, these are just tools and clues. They're not fortune-telling devices. They can't guarantee success. The market is a complex beast, influenced by countless factors, many of which are unpredictable. So, as you step into your role as a stock market detective, keep this in mind. No tool, no indicator, no pattern can give you all the answers. You need to stay curious, stay vigilant, and never stop learning. Remember, the past may not predict the future, but it sure can provide valuable clues. Ever wished you could predict the future? Well, in the stock market, you kind of can. Now don't get too excited. We're not talking about crystal balls or tarot cards here. What we are talking about is the art and science of predicting stock performance, and while it's not foolproof, with a bit of knowledge and understanding, it can be a powerful tool in your investment arsenal. Let's start with the basics. To predict stock performance, you need to keep an eye on a few key factors. First up is company performance. This includes everything from a company's earnings reports to its leadership team. Is the company consistently profitable? Is its leadership stable and competent? These are all questions you need to ask. Next up is industry trends. Are certain sectors booming while others are busting? Is the company's industry on an upward trajectory, or is it facing headwinds? For example, if you're looking at a tech company and the entire tech sector is on a roll, that could bode well for the company's stock. Finally, don't forget about economic indicators. These are things like interest rates, employment figures, and GDP growth. They can give you a sense of the overall health of the economy, which can impact individual stocks. So there you have it. Company performance, industry trends, and economic indicators. But remember, predicting stock performance is more of an art than a science. There's no surefire way to know what a stock will do. But by understanding these factors, you can make more informed decisions. And one more thing, don't just look at the present. To truly predict stock performance, you need to understand the past. How has the stock performed historically? What were the market conditions like then, and how do they compare to now? It's about spotting patterns and making educated guesses. Predicting stock performance isn't about seeing the future, it's about understanding the present in the context of the past. So go ahead, dig into that data, analyze those trends, and make your predictions. Who knows, you just might hit the jackpot. So, are you ready to become a stock market oracle? As we wrap up this journey into the world of stock market analysis, let's take a moment to reflect on what we've learned. We started by unraveling the stock market, peeling back the layers of complexity to reveal its core principles. We discovered that it's not just a chaotic whirl of numbers and charts, but a dynamic ecosystem driven by demand and supply, fueled by real-world events and investor psychology. Then we dove into Stock Market 101, grasping the basic concepts that form the foundation of any successful trading strategy. We learned about shares, indices, dividends, and more. We realized that understanding these fundamentals is the first step towards making informed investment decisions. Next, we decoded market trends. We explored different techniques to interpret market movements, from simple line graphs to complex candlestick charts. We learned how to identify bullish and bearish trends and understood that recognizing these patterns can help us predict future price movements. In the fourth scene, we ventured into the realm of predicting stock performance. We discovered that while no method guarantees success, a combination of fundamental analysis, technical analysis, and intuition can increase our chances of making accurate predictions. We learned that informed predictions are not mere guesses, but are based on a careful analysis of available data. Now, as we conclude, remember that knowledge is power. In the realm of stock markets, this power comes from understanding its basic concepts, being able to read trends, and making informed predictions. Remember, the stock market isn't a game of chance, but a game of strategy. But also remember, the stock market is as unpredictable as life itself. It can throw curveballs at you when you least expect it. So stay humble, stay curious, and never stop learning. Keep refining your strategies and adapting them to the ever-changing market conditions. The stock market isn't a crystal ball, but with the right tools and understanding, you can make it your magic mirror. So go forth and conquer the world of stocks with your newfound knowledge and insights.